Right now, you might just be sitting on your couch, totally relaxed. Maybe you're, sipping your morning coffee. But beneath those very cushions you're sitting on, there is a wild, high-stakes global economic storm raging.
Oh, absolutely. I mean, it is entirely invisible to the naked eye, right? But the ripple effects dictate, well, nearly everything about the physical environment you live in.
Yeah, exactly. So welcome to the Deep Dive. Today, we're taking a really fascinating look under the hood of something most of us just completely take for granted.
The furniture right in our living rooms.
Right. And our source material today is freshly released. We have the Q3 Fiscal 2026 earnings report, along with the accompanying management commentary from Flexsteel Industries.
And for anyone tracking, they trade on the NASDAQ under the ticker symbol FLXS.
Yeah, FLXS. And for some context here, this is a 130-year-old American residential furniture giant based out of Dubuque, Iowa.
Right, and I know what you're thinking. A corporate earnings report from an Iowa furniture company might sound like, I don't know, a really dry stack of spreadsheets at first glance.
Like total snooze fest, right?
Exactly. But in reality, it serves as this perfect microcosm of the modern global economy. It acts as a real-time stress test for how physical goods actually move around the planet.
Which is our mission for you today. We are looking far past the raw data to decode exactly how a legacy century-old company navigates inflation, geopolitical conflicts, and an incredibly hesitant consumer base.
It's essentially your ultimate shortcut to being well-informed on the modern supply chain.
For sure. But before we get into the global drama, though, we really need to look at the financial scoreboard just to understand the stakes.
Yeah, you have to. The financials are the foundation of this entire narrative. I mean, you cannot understand their survival strategy without seeing where they currently stand.
Let's do it. So the turnaround we are seeing in this Q3 report, it's a textbook example of doing more with less. Net sales for the quarter tick up just barely.
Barely at all, yeah.
They hit $115.1 million,
Yeah.
which is only a 1.0% increase from the prior year. But their GAAP operating income hit $8.2 million.
Which represents 7.1% of their net sales.
Yeah. And let's clarify GAAP for a second for the listeners.
Oh, sure. So GAAP stands for Generally Accepted Accounting Principles. It essentially means, this isn't some vanity metric dressed up by corporate executives to look good.
Right. No funny business.
Exactly. No funny business. It is the standard by-the-book measure of their operational profitability, totally free from creative accounting tricks.
And hitting that 7.1% mark is a massive shift when you look at where they were sitting exactly 1 year prior.
Oh, it's night and day.
Yeah, because in the exact same quarter the prior year, they didn't make a profit at all. They actually posted an operating loss of $5.1 million.
So they swung from a $5 million hole to an $8 million profit.
Right. All while barely selling any more actual product than they did before. They also reported that their gross margin increased by 40 basis points to 22.6%.
And for anyone who doesn't, live inside financial spreadsheets, 40 basis points is literally just a 0.4% bump.
Yeah, which might sound totally minuscule on paper.
It does, but in a tight margin manufacturing business, squeezing out almost 0.5% of extra margin across millions of dollars of product? I mean, that is a solid operational win.
Okay, let's unpack this. Because to make sense of how a business pulls off a $13 million profit swing without a massive boom in sales volume, you have to look at their strategy.
Right. How do they actually do it?
It's like imagine running a bakery where you actually sell fewer cakes overall, but because of a sudden flour tax, you just increase your prices across the board.
Okay, yeah.
Plus, you manage to convince the customers who do actually walk in the door to buy your premium, high-margin wedding cakes instead of your basic low-margin cupcakes.
That bakery comparison illustrates the mechanics perfectly, actually, because the earnings report explicitly credits this massive financial swing to two primary factors. And the first one is higher pricing from tariff surcharges.
Which brings up a larger supply chain question, right? Like, why is an Iowa furniture company dealing with tariffs to begin with?
Well, it's because the modern furniture industry relies really heavily on imported raw materials. Textiles, individual mechanical components.
Oh, sure.
So when a government imposes a tariff, it essentially acts as a tax at the border. But Flexsteel didn't simply absorb that massive new expense. They passed those specific costs along to the consumer in the form of a surcharge.
Got it. So they basically isolated the cost.
Precisely. They isolated it. And the second factor driving their profit was a favorable sales composition of higher margin products.
The wedding cakes from the bakery analogy.
Exactly. They sold lower unit volume, meaning fewer couches overall, but the ones they did sell were from their premium lines.
I mean, I see the strategy, but I really want to challenge how they pulled that off.
Okay, how so?
Well, if consumers are dealing with inflation across the board, how do you successfully convince them to buy the most expensive item on the showroom floor?
Ah, right. Well, the secret is you don't convince the average consumer.
Good.
Yeah, you target the demographic whose discretionary income isn't quite as tightly squeezed. Look, when inflation hits, the budget-conscious shopper just stops buying furniture entirely.
Right, they just delay the purchase, make the old couch work for another year.
Exactly. The luxury or premium buyer, however, they still have the capital to upgrade their home. So, by successfully leaning into those premium products, Flexsteel catered to the exact consumers who were still willing to spend.
Okay, so they successfully executed a premium pivot. They made more money off fewer sales. But looking at the rest of this balance sheet, something really isn't adding up for me.
What's standing out to you?
Usually when a legacy company is, clawing its way out of a multi-million-dollar operating loss, they go into pure survival mode.
Oh, absolutely. They slash everything.
Right. They aggressively slash internal costs, they freeze hiring, halt research, just to make the quarterly numbers look as attractive as possible.
What's fascinating here is that Flexsteel did the exact opposite of that. Yeah. If you look at their SG&A, and that's selling, general, and administrative expenses, which covers, daily operational overhead, marketing, corporate costs.
Right, the stuff you usually cut.
Exactly. It actually increased. It went up 50 basis points or 0.5% to 15.5% of their net sales.
Wait, they were losing millions last year. Why are they actively inflating their corporate overhead instead of hoarding every single penny?
Because they're actively investing in growth initiatives. I mean, even while recovering from a tough prior year, management is funneling capital right into consumer insights, new product development, and customer experience.
Wow.
Yeah, they aren't treating this quarter as a finish line. They are spending money right now to protect and expand their market share for the next decade. It is a highly confident financial maneuver.
Okay, so the financial scoreboard paints a picture of a massive success story. I mean, they flipped a loss into a profit, they targeted the premium market, and they feel secure enough to invest in their own overhead.
Right.
That makes it incredibly jarring when you read the actual management commentary from their CEO, Derek Schmidt.
Oh, for sure. The tone of the report shifts so abruptly from triumphant to, well, highly cautious.
Yeah, Schmidt goes out of his way to describe their current operating environment as, quote, challenging and dynamic.
Yeah.
And when you dig further into the commentary, it paints a rather grim reality of the market. So why is the leadership sounding the alarm if the operational profits look so solid?
Well, because those profits were generated in an environment that is rapidly deteriorating right beneath their feet.
Okay.
The report details incredibly choppy order trends. So early in the third quarter, severe weather fundamentally disrupted their performance. It delayed shipments.
Right, just physical logistics.
But as the quarter progressed, that temporary weather disruption was replaced by a much heavier systemic issue, which is macroeconomic uncertainty.
Which brings us back to the global storm we mentioned right at the start of the deep dive.
Exactly. The report specifically cites current developments in Iran and the escalating conflict in the Middle East.
And I think this is the part that genuinely blows people's minds. The disconnect feels huge. I mean, how does a geopolitical conflict in the Middle East directly impact a residential furniture manufacturer operating out of the American Midwest?
It all comes down to the fundamental building blocks of their supply chain.
Okay.
When geopolitical tension rises in oil-producing regions, global fuel costs spike.
Right, of course.
That immediately makes shipping heavy furniture across the ocean or even just loading it onto a domestic truck fleet significantly more expensive.
Right. Moving big, heavy boxes gets pricey.
But the connection goes much deeper than just the diesel in the delivery trucks. You have to look at what a modern couch is actually made of.
Yeah.
It isn't just wood and fabric. The cushions are heavily packed with polyurethane foam.
Oh, and polyurethane foam is derived directly from petrochemicals.
That is the vital link. The report notes that cost pressures are increasing across their entire supply chain, driven largely by higher fuel and petrochemical-related input costs stemming from the Middle East conflict.
Wow. So suddenly, the very foam inside the cushions costs more to chemically produce.
Exactly.
That explains the manufacturing side, for sure. But the end of the supply chain, the stores and the shoppers, they're also reacting to this macro environment.
Oh, the anxiety is highly contagious. Flexsteel notes in their commentary that their retail partners are frankly terrified of holding inventory.
How does that retail inventory shift actually work on the floor, though?
Yeah.
Because if I walk into a furniture showroom, it always looks packed with options.
The showroom floor will always look full, yeah. But the backroom strategy completely changes.
How so?
In a booming economy, a retailer holds a massive warehouse of boxed inventory. That way, a customer can point to a couch and literally take it home that exact same day.
Right, instant gratification.
But when those retailers fear a looming recession, they stop buying backstock. They keep the floor models for display, sure, but they operate entirely on a made-to-order basis.
Oh, wow.
Yeah, they force the manufacturer, in this case Flexsteel, to hold the bag and manage the actual inventory risk.
Which extends lead times and puts all the pressure back on the manufacturer.
Exactly.
And the retailers are doing this because the ultimate buyer, the consumer, is intensely spooked right now.
Oh, completely. The report highlights that consumer confidence is taking a direct hit from inflation concerns, rising energy costs, stock market volatility, you name it.
And buying a new premium sofa is a major discretionary purchase.
It really is. It is often the very first thing a household crosses off their budget when they feel financially insecure. You can delay replacing a slightly worn couch for years if you're worried about your grocery bill.
Yeah, that makes total sense. Here's where it gets really interesting, though. As a listener, you might be looking at this equation and thinking, wait, if input costs for fuel and petrochemical foam are rising so fast, why doesn't a legacy brand like Flexsteel just do exactly what they did with the tariffs?
Just raise the prices again.
Yeah, why not just hike the sticker price of their sofas again to completely cover the difference and protect that nice 7% profit margin?
It is a completely logical strategy on paper. But if we connect this to the bigger picture, it reveals the CEO's ultimate dilemma. The consumer is intensely price sensitive right now.
They are actively looking for a reason to walk out of the store.
Right. Schmidt explicitly states that while management is evaluating pricing actions to mitigate these raw material pressures, the current environment requires a, quote, thoughtful and measured approach.
Thoughtful and measured.
Yeah. If a company mechanically raises the retail price of a sofa every single time the cost of a barrel of oil goes up, they will eventually hit a ceiling where the consumer simply refuses to engage.
Right. You might protect your profit margin on a spreadsheet,
Yeah.
but you completely kill the actual consumer demand in the real world.
Exactly. You end up with beautifully priced furniture sitting in a warehouse that absolutely nobody is buying. It is a precarious tightrope walk.
A total balancing act.
Right. You have to absorb enough of the rising supply chain costs to keep the customer from running away, but pass along just enough to keep the factory lights on.
And that tightrope is suspended over a geopolitical landscape that is entirely out of their control.
Completely.
So we've established the heavy external pressures bearing down on the company. The chemical components are getting more expensive, the retail partners refuse to carry backup inventory, and the consumers are, clutching their wallets.
It's a perfect storm.
It is. And that brings us to the future. How does leadership actually steer a legacy business through these specific incoming storms?
Well, we can see their strategy by looking at their Q4 projections. Management is effectively bracing for impact.
Okay.
They expect near-term demand and profitability to remain firmly under pressure. The team is projecting that fourth quarter sales will likely be flat compared to the prior year. Nobody is expecting a sudden economic boom here.
So they aren't expecting growth, but they are expecting to hold the line on their margins. They project operating margins will hover right around that same 7% level they achieved in Q3.
Which is impressive. Maintaining that margin requires incredible discipline when your raw materials are getting more expensive and your top-line sales aren't growing.
Right. So what does this all mean? How do you actually survive that kind of squeeze? It's not about driving blindly into a macroeconomic blizzard.
No, not at all.
It is much more mechanical than that. Imagine hitting a massive axle-breaking pothole on the highway.
Okay, I'm with you.
If you are driving a cheap car with a bad suspension, you feel every bone-jarring impact, and you might actually lose a wheel. But if your vehicle is equipped with top-tier heavy-duty shock absorbers, the wheels beneath you might violently bounce, but the chassis, the cabin where you're sitting, it stays perfectly level.
That's a great way to picture it.
Right. And for Flexsteel, those shock absorbers are built entirely out of their balance sheet.
Yes. And that is the critical advantage of being a 130-year-old company. You have had decades to build a financial fortress.
Literally a fortress.
The earnings report shows they ended the quarter with a cash balance of $57.3 million.
That is over $57 million in pure cash, just sitting there ready to deploy.
Right. They also reported working capital, which is their current assets minus their current liabilities of $142.2 million.
Wow.
And on top of that, they have another $54 million available on a secured line of credit.
That is a massive financial shock absorber.
It really is. It provides the ultimate luxury in a volatile market.
Yeah, time to figure things out.
Exactly. When a business has that level of liquidity, leadership doesn't have to make desperate short-term decisions. They don't have to ruin their brand prestige by liquidating premium inventory at rock-bottom prices just to make payroll next week.
Yeah. And that liquidity also allows them to continue investing in the categories that actually work, regardless of the macro environment.
Right, like we saw with the SG&A spending.
Exactly. The report highlights that they are doubling down on their core drivers, specifically their health and wellness category.
And that is an incredibly smart allocation of resources.
Why is that?
Well, health and wellness features in furniture, things like ergonomic lumbar support, power lift chairs, or specialized reclining mechanisms, those are often viewed by consumers as a biological necessity rather than a luxury.
Oh, that's interesting, especially for an aging demographic.
Exactly. When a product relieves physical pain or aids mobility, it becomes much quote-unquote stickier. Consumers will still find room in their budget for a chair that improves their daily quality of life, even when overall discretionary spending is tight.
Okay, so they have the wellness category, but they are also leaning heavily on their heritage. The report specifically calls out their patented blue steel spring technology.
Oh, yeah.
Now, from a marketing perspective, pointing to a 130-year-old patent is a brilliant move. But let's look at the actual mechanics of why that matters. How does a blue steel spring actually differ from just a standard couch?
Good question. So most traditional couches use individual coiled springs or zigzag wires. Over time, those individual components can snap or sag or lose tension because they basically bear the brunt of the weight independently. Okay, they just wear out over time.
Right. But the blue steel spring is a patented interconnected ribbon of steel. It doesn't rely on hand-tied strings that degrade over time.
Okay.
Because it moves together as a single riveted unit, it distributes weight evenly across the entire frame.
Which means the couch feels the exact same in year 10 as it did on day 1.
Exactly.
And when the world feels increasingly cheap and disposable, reminding a financially stressed consumer that your product is built with blue steel that lasts for generations, I mean, that is a highly compelling value proposition.
It really is. And this raises an important question for anyone analyzing corporate strategy today. How do you actually measure business success in an environment this unpredictable?
Right, because you can't control the environment.
Exactly. The duration and severity of these supply chain pressures depend entirely on geopolitical developments that Flexsteel's management cannot control. A CEO in Iowa cannot stop a conflict in the Middle East.
No.
Nor can they dictate the global price of oil. They are passengers on the macroeconomic train, just like the consumers buying their furniture.
Yes. However, what leadership can control is their operating model. By maintaining disciplined cost controls, carefully managing their pricing strategies, utilizing their massive cash reserves, and continuing to invest in consumer innovation, they are not just trying to survive a bad quarter.
They're playing the long game.
Right. A truly resilient operating model allows a company to absorb the blow today and position themselves to capture massive long-term shareholder value when the market eventually stabilizes.
Because when the economic dust finally settles, the competitors who didn't have heavy-duty shock absorbers or $57 million in cash reserves, they might not be around anymore.
Exactly. Recessions and supply chain crunches are the exact moments when market share quietly changes hands. The companies with strong balance sheets survive and seamlessly absorb the customers of the weak.
It really is a masterclass in corporate endurance. Let's bring all of these threads together, though. We started by looking at a legacy company that managed to pull off a pretty remarkable operational trick, turning a $5.1 million loss into an $8.2 million profit without selling significantly more volume.
Right.
And they achieved this through smart tariff pass-throughs and pivoting their consumer base toward premium products.
Yet that financial victory is immediately tested by a brutal global reality. Geopolitical conflicts occurring thousands of miles away are actively driving up the cost of the petrochemical foam and freight fuel needed to basically build and move their furniture.
Yeah.
And this is happening at the exact moment when inflation-weary consumers are terrified to spend money, forcing retailers to completely shift their inventory risk.
And to survive it, Flexsteel is relying on a bulletproof balance sheet, leaning into the mechanical superiority of their 130-year heritage and quietly investing in future growth while their competitors are likely out there panicking. This entire narrative proves why taking the time to look past the surface of a seemingly dry corporate earnings report is just so valuable. It grants you a high-definition understanding of the global forces that are literally shaping the world around you.
It really reveals the hidden architecture of our everyday lives. I mean, from the price of oil to the cushions in your living room, the global economy is just a single interconnected web.
Which leaves us with this final thought for you to mull over. Next time you sink into a comfortable chair in your living room, take a second to just feel the cushions.
Yeah, think about what's inside them.
Ask yourself, if a geopolitical conflict on the exact opposite side of the planet can directly dictate the cost of the petrochemical foam beneath you and the fuel used to ship it to your door,
Then how truly local is any physical product inside your home?
it is a fascinating perspective to carry with you. We will leave you to explore that question on your own. Thank you for joining us on this deep dive.